Good evening, all the joinees. Welcome to the NGEN Markets webinar. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So meanwhile, others join, we will introduce the topic for today's session. So what we will really be discussing today is how can we compare the performance of various typically mutual funds with their respective benchmark indices. So what we will consider for this is we'll choose one of the categories. We'll load that category typically in the fund section, take them to compare section, and check how various parameters with respect to parameters such as beta, correlation, and annual excess can really be checked off this particular list of funds with their respective benchmark indices. After that is done, we will also have a look at how we can make a decision as to which of these funds are outperforming the benchmark and which are not, using this plain simple ratios, right? We will then understand what each of these ratios mean. Next, we will move over to understand how we can do a SIP analysis and a point-to-point analysis, which helps us in doing a lump sum analysis, right? So monthly SIP versus a lump sum analysis, and also consider rolling analysis. So rolling returns analysis typically helps us in checking the consistency of the funds in generating returns. Right, so we will have a look at rolling returns analysis as well. After that, we will move ahead and check how drawdowns analysis on the platform helps us in determining what is the strength of each of these funds versus that comparing that with the benchmark to recover from a particular loss. Because what happens is in volatile times, it is very, very important to note how quickly does a fund recover from its loss, right? How sticky are its, volatile times typically, how sticky is the loss period, right? That tells us in determining the resilience of the fund, right? After that, we can move over to the Q&A session wherein you can get your questions answered. You can do so by either typing it in the chat box or directly unmuting yourself to speak. So let us now begin. Let's go directly to the NGEN Markets screen. So this is our NGEN Markets platform. For the purpose of our webinar, we will be focusing today on two sections. One is the fund section, wherein we will be onboarding a list of funds to the compare. So let's directly head over there. So in this case, let's choose a category of focused. So in this case, go to filter categories. Focused equity funds will be in equity bucket. Right, so what I've done is I've chosen focused as an asset class subcategory, and I've clicked on apply. So let's just simply clear all the filters here. So these are all the focused equity funds. Now, in order to really limit our analysis for today, let us specify some basic filter parameters. So by basic filter parameters, I mean to say minimum AUM, or for that matter, minimum age. Right, so let's typically put in minimum AUM as 1,500. And minimum age as 3. So now in this particular list, I want only those funds who are at least 3 years old and above, right? So at least 3 years old. So I put in these parameters, I click on apply. So these are the funds that actually meet the two parameters that I have set, minimum AUM of 1,500 and minimum age of 3. Once I have them here, I can simply take them to the compare section by clicking on one single tab, which is add top 50 to compare. Up to top 50, all of these funds are going to get added in the compare section. So I simply click on this, and we have about 13 focused funds, right? And they have gotten added in the compare section. Now, once they are here, what you can then do is you can do any particular, you can specifically choose any particular parameter and check what is the performance of each of these funds as compared to others. Now this is simple plain peers analysis, right? Here, mind you, we're not adding any benchmark or any category average for that matter, right? So simply doing a peers analysis. Let's say I want to rank them or typically see which of these funds are better if Sharpe ratio as a parameter is considered. So I simply click on Sharpe ratio as a parameter, and it gets sorted in either ascending or a descending order, top to bottom or bottom to top. And I can see that, okay, from inception, as you can see, I've not put in any particular start date here, right? None of the start dates are entered here. So this performance, you can see here, is since inception of the respective funds. Now, if we were to see and if we were to compare a relative performance of each of these funds with a benchmark, then number one thing that we can do is add a reference index or a respective benchmark in this compare section as a row item. To add that, number one thing that you can do is go here at the top, add other items, right? And these are typically focused funds. So the benchmark is a Nifty 500. So I simply go and add in a Nifty 500 as a benchmark. So the moment I do that, you will see Nifty 500 has gotten added here. And that indicates this is the index. Now, if I now click on Sharpe ratio as a parameter, now this tells me since inception of each of these mutual funds, the date that is being really considered, DSP focused fund has a Sharpe ratio which is lesser than that of the index itself. Okay, mind you, we have not put in any date here. Now, in order to make this analysis more relevant, let's go ahead and put in a start date. Let's say we are doing a last 3-year analysis. We simply go here and put in November 2020 as the start date. So let's consider 20th of November and I click on go. So in order to put in a start date for the performance of each of these funds, you need to put in the start date here, right here. There's a small settings icon. Simply click on this and this is where you will put in the start date. Now, the start date that you can see here will just come to that. That relates to another specific tab, which is relative columns too. We'll just come to that in a bit. Okay. Now, once we have put in a start date here, you can see all of these parameters now that are really appearing in the green columns here, right? Color coded as green. Those have gotten modified to represent the last 3 years performance. So in this case, the CAGR for that matter is last 3 years CAGR, right? From November of 2020. I simply click on, sorting this, ascending, descending. This tells me that, okay, index CAGR is about 18%. And typically these funds that get plotted above my index have actually generated a better CAGR than Nifty 500 per se, right? So HDFC, Nippon, Franklin IPRU, 360 typically IIFL and Invesco, right? These are the funds that have generated a better CAGR. Now that becomes a relative comparison of this particular set category funds with its benchmark. Now, if you were to typically check in simple ratios like beta, alpha, annual excess, and typically correlation analysis, then you simply use this scroller and move or drag it to the right-hand side. In this case, you can see this pink color-coded columns represent relative columns too, which is typically these ratios, right? Annual excess, beta, tracking error, info ratio, and correlation. But as you can see, currently there is no data here. Now, why is there no data? We have added in a benchmark, but in spite of that, there is no data here. That's because in order to make this data come up, you need to put in that benchmark right here in relative columns too. Only when you put in a benchmark here will these columns really have data, right? The data will come in these particular columns. So now the start date, the relative columns too right here, search indices, and this calculate button are really for these pink color coded columns. These have nothing to do with these particular, green color coded returns parameters of these mutual funds. So whenever you load in a list of funds, you will have to put in a start date right here, because you putting start date here will not have any impact on these particular set of green columns right here. Okay, only when you put in a parameter here, which is an index, only then putting a start date here makes sense. So now let's do a comparative analysis with respect to a benchmark. Again, I'll do what I'll do is I'll add a Nifty 500 as a benchmark here. The moment I do that, it will take into consideration the calculate automatically ticks, right? So basically what you're saying is, I want you to calculate all of these ratios in consideration with Nifty 500 as a benchmark. So the moment I do that, all of these figures are going to come up. Now, the second important thing that you need to ensure a apples to apples fair comparison is the start date at both places should be the same. So in this case, in the returns column, we have considered a start date of 3 years, right? So 20th of November, 2020 onwards. So we simply go here in the relative columns to tab and put in the same start date. So 2020 and November. Now these ratios that you can typically see indicate performance of this particular benchmark in comparison to that of these funds from 20th of November 2020. Now simply let's sort them on the basis of annualized excess. Okay, and I can check that these are the funds that, for that matter, Access Focus 25 fund. This particular fund has generated a negative excess over the benchmark. That means it has not managed to outperform the returns that were generated by that of Nifty 500. Right, and this is annualized basis since the last 3 years. On the other hand, if you just simply check this cumulative excess column, it tells you entire 3-year period. If you typically do not annualize it, that tells you what was the cumulative excess over the benchmark. In this case, of course, it's negative, right? So there is no excess. On the other hand, if you were to simply check this HDFC focused fund, for that matter, HDFC Focus 30, it has managed to generate an excess return over the benchmark return. Now, benchmark return, if you were to check that can simply be checked right here. So if you want to check, let's say, a typically cumulative return of the benchmark, how much did Nifty 500 give in the last 3 years, that can be located here, right here. Right? So Nifty 500 as an index, its return was 67.07% in the same period. On the other hand, my particular fund, right, which is HDFC Focus 30, gave in a cumulative return of how much? 116.59%. The difference between these two is typically what is getting captured right here. The excess of one particular fund over that of the benchmark is a 49% excess return. Now, if you turn that to an annualized excess, that comes to about a 16%. And that is what is indicated here. So this can be termed as a modified alpha, that we are trying to say that these are the funds that are generating a positive alpha over that of the benchmark, right? On the other hand, the second index, or the second ratio, which typically is beta, tells you what is the risk of each of these funds when it is compared to that of the benchmark. So as you can see, before even discussing all of this, let's see Nifty 500 with itself. So this is a metric structure on the column. So at the top, it's also Nifty 500, and as a row item, it's also Nifty 500. So the benchmark's beta with itself will always be 1. Okay, so we will now be measuring the fund's beta with that of the benchmark. So if any of these mutual funds have a beta of less than 1, that typically will tell you that these funds are lesser risky as compared to that of the benchmark. On the other hand, if a beta number is more than 1, that will tell us that this particular fund has or takes into consideration more risk, or it's more risky as compared to that of the benchmark. So in this case, you can simply see that all of these funds in this list have reported a beta of less than 1. Of course, Nippon India is very, very close to 1, so 0.99. And with almost similar risk, the fund has managed to generate a positive return over that of the benchmark. And that's definitely a good thing about this. Right? So this beta, typically the risk is very, very similar to that of the benchmark. And in spite of taking similar risk, if there's a fund that is generating an excess return, you would definitely try and include that in your portfolio. On the other hand, if you have a look at the lowest beta number, that is typically this fund, right? So SBI Focused Equity. Of course, this particular fund has taken in lesser risk as compared to the benchmark, but it has not managed to generate a better return. Right? The annual excess, as you can see, is negative. But simply if you consider this fund, right? So of course, the risk is less than 1. So rather, the beta is less than 1. That typically says with a lesser risk, it has generated much better alpha, right? So that's typically how you can interpret these two together, right? This is a measure of risk, and this is a measure of returns, excess returns. That is about beta and annual excess. Now moving on to correlations and tracking error. So first of all, let's discuss tracking error. To understand tracking error in a little better manner, what I will really do is I will add in a passively managed fund to this list. So as you can see, currently all of the funds that we really have here are actively managed funds. So let's simply add in a passively managed fund to this list. So a Nifty 500 index fund. Okay, so we have a Motilal Oswal. I simply click on this and it will get added as a row item. Okay, the moment it gets added as a row item, you need to check if the dates have changed, right? So typically when you modify this list, the dates that will appear here are bound to change, right? You need to set it back to the days that you had initially put in. So we had put in a November date, so 20th of November 2020. And now again, it's a fair comparison. Now let us sort tracking error in ascending order, so lowest to highest. So we can see that this passively managed fund, which is an index fund, has a tracking error just above 1, right? The purpose of passively managed funds is typically to piggyback the returns or the performance of the benchmark, right? And that is exactly what this fund is doing. Of course, there are, the slight variation is due to the expense ratio and, such other things, right? Management fees, right? If we just ignore that, it is trying to replicate the performance of the benchmark. And that is exactly what we can see with very, very low tracking error. The tracking error of passively managed funds will be very, very less. Because its deviation from the methodology of investment methodology of the index is going to be very, very minuscule, right? There's no change. Typically, if tomorrow, if the Nifty 500 as such reduces its weight into Reliance, it is the fund, the Motilal Oswal Nifty 500 index fund is bound to do that, right? On the other hand, these actively managed funds, what they're trying to do is they're trying to do something different in an attempt to generate or outperform the benchmark, which is, of course, in this case, Nifty 500. Now, once we are through with this explanation, then we can understand this annual excess in much better manner. So now, has the strategy of doing something different than the benchmark in order to achieve better return, has it worked or not? How will you check that? Simply sort this on the basis of annual excess. Now, in this case, we can see that it has deviated from the benchmark to an extent of 5.90%, right? Its deviation is 5.90 as compared to that of the benchmark. But with that, it was not able to generate an excess return as compared to the benchmark. In fact, it has generated a negative excess. So in fact, there is no excess. It was not able to even match the benchmark returns, right? On the other hand, there is this particular fund, rather this list of funds, if we simply sort this in descending manner, these were the funds that actually managed to meet their their strategy really worked, right? The strategy of deviating from the benchmark really worked, and it generated an annual excess, which is positive, right? So this is how you can understand annual excess, beta, and tracking error in tandem with each other. So all of these three are related in this manner. Now, lastly, let's come to correlation analysis, which talks about the directional similarity in the movement, NAV movements of each of these funds with that of the benchmark. Now, before diving into correlation here, let me come to this correlation. So what you can see here is typically each of these funds correlation with each other, right? So for an example, Motilal Oswal focused fund, funds correlation with Kotak focused equity funds correlation, that is typically 0.92. Right, so correlation as a measure, ranges between -1 to a +1. So if these numbers are closer to 1, that means the correlation or the strength of their relationship is stronger, right? That means if Motilal Oswal goes up, 92% of the times Kotak focused equity is also going in the same direction. It talks about the direction of the movement of NAV, right? And of course, not about the magnitude, right? So it is going to tell us what is the directional similarity between the NAVs of a pair of funds, right? And the calculation methodology that we at NGEN follow is we consider daily NAV movements of each of the pair of funds and calculate this correlation analysis. So with respect to data points every single year, we have 260 data points every single year, and we calculate these correlations on a daily basis. So you will see this correlation number changing every single day, right? Now, this correlation talks about individual funds correlation with any of its any of its peers, right? Typically, whatever you have in this main list will be the correlation of that particular fund with the other. Now, the correlation that you can see here in the pink color coded columns is with that of the benchmark. Now, the correlation of, for that matter, HDFC with Nifty 500 is a 0.93. That means it is moving in the similar direction as compared to Nifty 500 93% of the times. That is how strong the correlation is. right? On the other hand, if you simply see, have a look at, there are some funds that, okay, for that matter, SBI, okay, it has slightly lesser correlation to that of Nifty 500, right? So if Nifty 500 is going down, SBI is going down only 88% of the times. As opposed to that, for that matter, this one, iProof, focused equity, is going down 95% of the times, right? So that is how you can interpret this correlation, which talks about the strength of the relationship of a fund with that of the benchmark, in this case, in the pink color coded columns here. This talks about directional similarity. Okay, that's the correlation analysis. Next, let's move on to understand rolling analysis, which happens to be the next tab. So let's simply go here. And let's understand rolling analysis. So rolling analysis talks about how consistent are the returns of a set of mutual funds that you typically have in the list, right? So we have considered a rolling window in this case of 260. So, in layman terms, what you can really understand rolling window as is holding period. Okay, so if you consider 1 year, so on everywhere on this platform, 260 is equivalent to 1 year in terms of working days. So here and after, I'm going to refer to 260 as 1 year. So if you consider 1 year as a holding period between the last 3 years, right? So any period of 1 year, if an investor stays invested in each of these funds in the last 3 years, now it could be any 1 year period, it could be any 260-day period, right? What are the average returns that are going to really accrue to the investor? That is what we're trying to address here. So now what we have done, let's honestly keep this consistent to 2020 November. So that will be exact 3-year period. So 20th of November, and I click on run. So now this means that HDFC Focus 30 fund generated an average 1 year return, 1 year rolling return of a 22%. Now, investor would have got this 22% average return if he would have held on to this particular fund between any 1 year time period between this particular 3-year time slot. Okay, now let us try and hover on this line chart of HDFC that you can see right here and locate this highest data point. So you can see that this is around this 55%. So let's try and hover somewhere there. 1 second. Okay, fine. Let's consider this this data point for that matter. Okay, so it's 41%, right? So in this case, HDFC Focus 30 fund reported 41% return. Rather, the investor who would have invested exactly 260 days prior to 8th of April 2022 would have gotten a 41% return on its investment. Right. So if you simply go on along this line, you can simply see various data points. And that typically tells you we calculate a rolling analysis on a daily frequency, right? And for that matter, this point, right? This tells you past 260 days, exactly from this point, if the investor would have stayed invested in this particular fund, exactly 260 days prior to 22nd of September 2022, he would have gotten a return of 20.83. Now, if you take average of this entire time series or the price series that you can see here, right here, that comes to an average return of a 22.49%. And that is how we have arrived at this average returns. Right. On the other hand, this typically tells you the volatility, how volatile have been these, entire along this price series. What is the volatility of the average returns from this entire data points? That talks about the volatility. This happens to be the double standard deviation of it, right? So this is different than the standard deviation that you see in the main list, right? That is simply basic volatility. On the other hand, this is double standard deviation, which is implied volatility for that matter, of the entire time price series data points that you can see with when considered against the average returns. On the other hand, this high and low are pretty simple. What was the highest return that was generated by HDFC Focused 30 fund in the if we consider 1 year holding period in this 3-year time period? This was the lowest return, and this tells you about the percentage positive. So in this case, you can see for HDFC, the lowest return is also positive return of a 7.17%. And therefore, the percentage positive is 100%. So that means 100% of the observations of HDFC fund have been in the positive quadrant, right? If we consider only 2 quadrants, One is above 0 and one is below 0. So one positive quadrant and one negative. So we can see each and every observation of HDFC has back tested into the positive quadrant. And therefore, the percentage positive is 100% positive return. This typically is the probability, right? 100% positive. On the other hand, we have some funds that have reported negative returns as well. So for that matter, Axis has generated a lowest return of negative 20.65. And therefore, you can see percentage positive is less than 100, right? So if there is any data point which is in negative part, it will typically not show a percentage positive of 100%. Right? That is how you interpret, let's say, so you want to choose better funds for typically a conservative investor. You simply sort these on the basis of positive percentage, and whichever lie in the top quadrant here, you would rather choose these funds over the ones that have generated lower positive returns, right? So these are typically suitable for maybe conservative investor. That is a call that you can take. Right. After that, what we can use rolling returns distribution for is to check which of the funds generate returns in the client's target return range. Let's say a client who is inclined towards investing through you tells you that his target return range is to generate a return anywhere between 10% to, let's say, a hypothetical as high as a 50%, right? And in this is his target return range. So he does not want his investments to generate a return which is even 1% lower than this. Neither does he want it even slightly higher than that. Of course, hypothetical, but let's consider that as a scenario, right? And then you simply put in his target return range in either of these buckets that you can see at the bottom. So let's put in 10% and a 50%, which is his target return range. And then after that, what you can see right here are the probabilities, right? So in this case, I can see that HDFC Focus 30 mutual fund meets the client's target return range 96% of the times, right? That means 96% of the times its returns, of course, 1 year returns, that's 260-day returns, 1 year holding returns have really backtested in this target return range of the client. That means it satisfies the client's target return range 96% of the times, right? On the other hand, there's this Motilal Oswal focused fund, which has a probability to generate return between a 10% and a 50%, only 29% of the times. So if you were to make a choice between a HDFC and a Motilal, choosing a HDFC over a Motilal would be a but obvious choice, because it has a higher probability of meeting clients' expectation, target expectation of returns, right? This is how you can use rolling returns distribution. After that, let's move over to understand monthly SIP and and of course, point to point, which talks about lump sum investment. So simply click on monthly SIP tab and you can run a simulation. So you just need to put in installment amount. So let's say we consider 10,000 monthly. If that is put in across a time period of, let's say, last 2 years, what would be the return? So let's consider November 2020. So 2021. And the last end date would be 23rd of November 2023. And I click on run SIP. Now, if I consider the last 2 years, the highest XIRR was generated by a HDFC Focus 30 fund, right? And the final value turns out to be a 3,09,000. If you were to run a detailed SIP analysis on one particular fund, all you need to do is simply click on this run detailed SIP, and this will get open in a new tab. Okay, this is the detailed SIP analysis that gets run for you for one particular fund. Now, what we are really trying to give data points here is, first of all, the XIRR. Then the number of installments that have elapsed, right? So in the last 2 years, total number of installments have been 25. That amounted to an invested value in the fund of, rather in investment of 2,50,000. And that 2,50,000 has become a 3,09,000 as on 24th of November 2023, right? And that is exactly what is being indicated here. This is the month-on-month split, how it will look like. So as the installments kept on coming in, how did the portfolio value really change? Of course, the portfolio value change is dependent upon the NAV of the fund, and that is what is being captured here, right? Month on month, as the installments kept on coming in, these were the units that were acquired based upon its NAV. Of course, you can take reports out of this. So there are 1-pager and 2-pager reports. You can simply click on this and a detailed 2-pager report will get downloaded. This will have the monthly SIP analysis for one particular fund. Let's go back. Now, if you were to do a lump sum analysis, let's say for the same time period, you then simply go to point, wherein we have now, given you an option to put in amount right here, right? Previously, it was only percentage terms. You could check the performance of each of these funds, lump sum performance in percentage terms only. Now, what we've done is we've provided this tab. So what you can do is simply put in the amount. Let's say if 10 lakh rupees or 1 lakh rupees were invested in each of these funds across different time periods. So the moment you land on this page, you will see 5 buckets, 1, 2, 3, 4, and 5. You can put in dates of your choice. So in this case, in the second scenario, what we've considered is a 5-year scenario. And we can see that this 1 lakh becomes, in the 5 years, if this is what we're considering, 361 focused equity fund gives in that becomes really 2,61,000, right? If you were to choose the same date that we were running SIP analysis for, you can simply do that by going on any of these buckets. And these dates, once you put in, unless you change it, they are going to get saved, right? So what you can do is you can build in scenarios here. In this case, we are building a 2-year scenario. 2023 November. And you click on sort. So this 1 lakh would have become a 1,38,000 in case of HDFC Focus 30. Right? That is how you can check how does a lump sum investment perform over a time period. You can put in dates of your choice right here. Right? If you want to check this in percentage terms, all you need to do is toggle between this annualized and absolute percentage, absolute toggles, and you can check this in absolute or annualized percentage terms. This is about point-to-point analysis. After that, the last part of the webinar, which discusses, where we'll discuss on drawdowns analysis. Now, until now, we were discussing on various parameters with respect to its, return performance, its risk. How does it really, compare with that of the benchmark? Those are the points that we were just discussing on, right? After that, we discussed on SIP and, lump sum. But now, this drawdowns analysis tells what is the strength of each of these portfolios to recover from a loss, right? This becomes very, very crucial when typically the times the markets are falling, right? There's some kind of volatility in the markets. And then the clients come with questions like, okay, how long should I be invested in this portfolio? Or for that matter, how long should I stay invested in this particular fund, right? Now, based upon this drawdowns historical analysis, you can say that, look, historically, this particular fund has never taken more than 100 days to recover its loss. And therefore, if 100 days have not really elapsed, you can, hold on for a slightly longer time. And of course, depending upon history, it has managed to recover its entire loss. This is what drawdowns analysis tells you. So the moment you come here, the first prompt that the system will ask you is to put in the start date. So let's consider a 2-year time period again. Now, these drawdowns are being calculated from 19th of November 2021. Let's sort this on the basis of size. So we can see highest drawdown with respect to highest magnitude is by Axis Focus 25 Fund. There was a drawdown of 25%, and which happens to be an ongoing drawdown, right? It has not completely recovered that drawdown. If you want to delve a little down or further into this, you simply click on this line chart. Okay, now this tells you that there was a loss of 25% that was reported by this particular fund when the NAV of the fund fell from 48 rupees to 35 rupees, right? The NAV fell from 48 to 35. That happens to be a loss of 25%. When did this happen? This happened between 2021 November to March of 2023. Now, if you were to check how much is this time, right? That is right here, available right here, the length, 494 days. So it fell 25% over a period of 494 days. And after that, the loss is still not completely recovered. It is only 58% recovered. And why is that so? That because the current NAV, as you can see, is about a 42.96. Right? So it has not reached back to its level of 48 from which it started falling. Now, the moment it will reach back to this 48.10 level, that will be termed as a recovery date. Right? And we can simply see this right here. Let's consider one particular fund that has actually recovered its losses. So let's consider this one, Motilal Oswal focused fund, right? So it fell 16%. The NAV fell from 33 to a 28 within about a 6-month time period, right? November to June. After that, the fund took 60 days, 61 working days specifically, to recover this entire loss of 16%. And when did that recovery happen? Ultimately, that happened on 12th of September 2022. That is when this particular fund recovered its entire loss and the NAV reclaimed the level of 33.98. Right? Now, if you were to corroborate this or actually check this, is this really true? What you need to do is simply hover on this line chart and just locate this particular date. So 12th of September 2022, that will typically be available in either of these white portions, because these gray portions indicate drawdowns or the losses. Right? So 12th of September 2022, 1 second. So somewhere here, right? So the NAV, as you can see, on 12th of September is 34.17, which is a tad bit higher than 33.98. And that is why we've termed that date of 12th of September as a recovery date. Right? This is how drawdowns analysis works. And you can not just check this on individual fund, but because we've introduced this in the compare section itself, you can simply sort this ascending, descending order wise, and you can check that which is the fund that recovers from its worst drawdown the quickest. Right? Simply sort this and you can see that, okay, HDFC Focus has recovered its worst drawdown in the next 20 days. Right? This is how you can compare it with the benchmark as well. So in this case, if you were to simply rank its second worst drawdown and check it with respect to the benchmark. So you can see that Nifty 500's second worst drawdown is of a magnitude of about 11%. And the index itself took 51 working days to recover its entire loss. On the other hand, we have some funds that have actually recovered its second worst drawdown more quickly as compared to that of the benchmark. So that indicates the strength of these funds, that they honestly recover faster as compared to that of the benchmark. So that is how you can interpret drawdowns analysis. That's about it from my side for the topic related discussion. Now, if you have any questions, you can please unmute yourself to speak or just type in your questions in the chat box. We'll try and answer them. Thank you.
There is a question asking how to check stocks held by mutual funds. So, Prajakta, can you show that, please?
Yes. All you need to do is simply click. Let's say you want to have a look at all the stocks in the portfolio of one particular mutual fund. Simply click on the fund. It gets open in a new tab. When it gets open in a new tab, you simply go on asset allocation, which is the second tab, right? You go here and this is a detailed portfolio, drill down of this particular mutual fund, right? So as on 31st of October 2023, Motilal Oswal has these particular stocks in its portfolio. Right now, if you want to check this on entire category or let's say one particular list of funds, that is also available. You simply head over to NGEN Markets Funds section and go to holding analysis. Right, we were having a look at focused categories, so let me again come to focused category only. So simply this is of course sectoral analysis. You can have a look at this. So if you want to check the entire focused categories sector wise analysis into each of the sectors, you simply type in focused funds here and you can see, okay, in banks as a sector, what is the weightage of all the focused funds taken together. Right, so it's about 21% as on 31st of October 2023. So you can have a look at that. Alternatively, if you want to have a look at a list of mutual funds, right? So as you were seeing here, right? So we had a list of mutual funds, focused equity mutual funds, and you want to have a look at all of their holdings in one single go, you can simply click on bulk download, which will download all of their current holdings into an Excel sheet in one single go. And then you can do a basic using basic Excel filter. You can have a look at which stock is highly invested in by this entire category. So that is possible.
Yeah, so
Okay.
they're also asking if you type the name of a stock, you can get the names of mutual funds that are holding it. So that's also
Yes.
available. So let's just show that as well.
Yes. So simply go to holding analysis again, and now go to equity holdings. Now, if you have a name of a stock in mind, let's say Hindustan Unilever, simply type in here. And these are all the list of mutual funds that invest in this particular stock, which is Hindustan Unilever. And of course, this list can be downloaded. You can typically put in any particular stock, right?
Any other questions? Please let us know. Okay, if there's nothing else, Prajakta, we can close for today.
Yes. So thank you everyone for joining in. You can check out the past webinar recordings uploaded on our YouTube channel. A link for our YouTube channel is right there in the platform itself. Simply click on this and you'll be taken to our YouTube channel. There's a dedicated playlist for all the webinar recordings. You simply go here and there's already 89 webinar videos uploaded. You can definitely have a look at these. So thank you everyone again and have a great weekend ahead. Thank you.